Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Wednesday, July 14th, 2021. We'll start out with a brief update on the broad markets. I want to take a look at the margin debt charts. It's amazing where levels are at today, and I'll talk a little bit on what that will ultimately mean when that trade gets unwound. We'll roll into select trade ideas that I've highlighted recently. And I'll just lay it out there, those that I'm bullish on, which includes gold, the euro, select commodities such as lumber and the grains, corn, wheat, and then certain things that I'm bearish on right now, and that includes crude and the energy stocks, financials, and industrials. So let's start out here with the Nasdaq 100. That's a 60-minute chart we're on. Same story. I'll say this every day unless this trend line is no longer valid or until we get the breakdown. This is what we're waiting for a sell signal. We did have a break here, and that took us down to the trend line. We've been back testing that minor trend line from below, but this is the big one. That's why it's color coded. It's a thicker trend line. We need to break that, and these divergences tell me it's coming. And when we break it, the scope of the divergences tell me that we're quite likely looking at a decent correction. And again, I think down to at least this 14,066 level. So what I'd like to do is quantify it. That just assumed that the top was in today. I'm not saying it is. We'll know when we get that sell signal. But from where we're at now, we're talking about a 6% drop. And again, that's just a minimum near-term swing target. There's certainly a lot in the charts that could indicate more if and when we get down there and take that 14,066 level out. So that's what it looks like on the Nasdaq 100 futures. No sell signal yet. Markets may continue to flounder around until the big fangs report here in a couple weeks. Could rally up into those earnings, or it could sell off before then. So we'll do this every day. We'll watch, wait. I always, I have a lot of sayings I made up in trading and investing. One of those is, if in life patience is a virtue, in trading it's an absolute necessity. So you just sit tight, be patient, and wait for the next sell signal there. I don't see any reason to go long. The trend is up. You buy dips back to the trend line, but I don't do that when you start getting these negative divergences. At that point, I look for a break of the trend line. All right, so that's NQ. Let's move on to ES. Hit these real quick. 60-minute chart of S&P 500 futures. There was our trend line, our breakdown there. Hit that 42.79.60-ish support. Been back testing it from below and then extending the divergences. In fact, we didn't even have, oh no, we did. I don't know why that line, okay, I keep drawing it in manually when I do the videos. Let me add it to this chart. I had it here before, divergence line. So we had a divergent high right here, and it played out for a little correction, but that divergence, it's the same divergence, at least from the same starting point. It's only grown larger. And so that would indicate, therefore, a larger drop, down to at least that level again, and quite likely down here at about 42.23. Let me just measure that out and see where that is. That would be about a 3.4% drop. And RTY, the small caps have already come under pressure lately. I pointed out back here we had a divergent high, negative divergence, and then a little minor trend line break that gave us a sell signal there, and we've been stair-stepping lower. Hit all three of these targets so far, and we're on this one, this 2207, rounded off, call it 2200. That's support there for the small caps. And so if that breaks with conviction, we're probably headed lower. The charts of the indexes look about the same. I could give you that, and QQQ is really the one I'm watching the most because of tech-heavy FANG stocks. That's our 60-minute chart right here. Trend line should load here in a second. There we go. And there's our primary uptrend line. So this chart mirrors that of the Nasdaq 100 futures pretty much. Same trend line off the same low, same divergences building, same overbought conditions, and just waiting for that catalyst known as a sell signal to put things in motion. Okay, and just remember we have, still have, and that hasn't changed for a while, nor will it, negative divergences all the way out on the weekly time frames of the indexes. So, and that could and likely will at some point play into, how deep the next correction will be, whether it's the next one or the one after that. So far for months now, it's been corrections ranging from 5 to maybe 10, 12%, and in the indexes, and then at one point we'll have a larger one. And this speaks to that a lot. This is the FINRA margin debt and the S&P 500. You can get this from Advisor Perspective or just Google margin debt. Look for charts there. And it's pretty telling. So you have the blue line is the S&P 500. You can see it down here, and the red line is margin debt. Now, margin debt, for those who are not familiar, when you open an account at a brokerage firm, you can either open a cash account. IRAs are cash accounts by nature; they can't be leveraged out. Although you can buy derivatives in them and essentially leverage yourself that way, but you're not borrowing money from the broker. And then with a regular brokerage account, you can either open a cash account or a margin account. And in a margin account, you sign something called a rehypothecation agreement, which says you allow your broker to take your shares. If you buy Apple or SPY or QQQ or any stock, any marginable security, you give your broker permission to take it and lend it out and give it to a trader, and those are short sellers. Or you can leverage up on the margin as well. You put in X amount, and they'll let you buy X times whatever, because that's margin. So they're basically using your portfolio, your securities and/or cash, as collateral, and allowing you to buy more stock or more investments or more securities than you actually have in the value in that account. That's margin. All right, so is what tends to happen is this is just throughout time, really. Well, at least since margin's been a thing in the modern financial markets. As you get in a bull market and the market's going up, like it was here, that was back in the dot-com bubble. More and more people get interested in the market, and more people that were making money start to leverage up, and they say, hey, I've got 100,000, I made 10% last month, that's 10 grand. Why don't I turn around and buy $400,000 of stock? Because if it goes up another 10% and I have 400,000, I'm going to make 40,000, and that's margin. It works great until it stops working, and what happens is it gets the ship gets a little too crowded on one side, and then it starts to list over, and eventually it comes crashing down. And that's why, if you've ever wondered, when we have bear markets, for those of you who've been around for a while, back in 2001, 2002 during the meltdown, 2007 to 2009 bear market, and some of the big corrections that we've had along the way, including what happened when COVID hit, if you're wondering how and why the market can possibly drop so fast, and that is a large part of that. One thing is a quick shift in economic expectations, and it's also psychological. Psychology plays in. People are losing money, and their stops get hit, or they feel their pain threshold, and they start selling out and selling, begets more selling. But a big part of it, where I'm going with this, is the unwinding of that margin trade. You might have what they call iron fist or iron hands, where you hold a stock and you say, you know what, I believe in this company. I'm absolutely certain I'm going to ride out any pullbacks, and in 5 or 10 years it's going to be worth a lot more, or whatever your horizon is. That's what the AMC group, I'll talk on that one later. That's one of their slogans they had, is diamond hands or something like that. And meaning hold, and no matter what, hold, and we will be rewarded. So let's say you have diamond hands, and you were buying dot-com stocks back in the bubble in 2000, making money. Every pullback you bought, every dip you were underwater, you saw profits go away, but then you were rewarded for holding. But finally there comes a time when that margin bubble pops, when it gets too high. There's too much margin, too many bulls, not enough bears in the market, and all of a sudden the tide goes the other way. You get those very fast and strong drops, and they are exacerbated because where I was going with that whole diamond hands thing, you may have intentions. You may say, hey, I'm in this for the long haul. I'm going to be in here 20 years, so I'm not going to sell my stocks no matter what. I'm going to ride out these bear markets and pullbacks. You don't have that option when you buy on margin, because your broker will issue a margin call, and if you don't sell, they will sell for you, and that's what happens here. So I've talked about it a lot of times in the past, identified quite a few of those big drops, and you can see it when margin goes up, and it's with the stock market, it hits extreme levels, you get those big drops. And again, this is over time. You see the bubbles have grown larger. And it makes sense to an extent. Over time, there's more people in the world, the financial markets grow, the value of things grow, so it would make sense at each cycle to see a higher and higher peak. But you can see there's what happened back in 2018. We had a huge amount of margin, and there was a huge drop there on the margin debt, and there was a big drop in the markets, another big drop right there. And then look, we've just gone parabolic. So this is, let me just end it here. I'm talking about this much. You can see the chart and see what happens. Back in the dot-com bubble, margin debt was about a 2.25 trillion. And you had here, what is that, about 2.8 or so. And then here you had back in 2018 at that peak. And remember, big correction came after. There we were. And we've just gone parabolic. So when it plays out, when this margin bubble gets unwind, nobody can say with certainty, but the charts will be our guide, and we'll start to look for more significant trend lines. Lately, as you probably know, I focus on 60-minute charts. That gives just the near-term stuff, give you some short-term sell signals, as I just talked about, maybe the next 5+% pullback. But then when that starts to materialize, we look at things such as support on the longer term charts, like the daily time frame, trend lines, price support levels, key moving averages, like the 200-day moving average and things like that breaking down. And then that will maybe be, or should be, an early sign of if and when we're going to see a lot more downside and see the unwinding of this unprecedented margin bubble that's going on right now. Okay, enough of that pessimist stuff. Again, pessimistic, optimistic. If you're a flexible trader and you can short and gain, make money in an up or down market, it's great. And again, that's what I just talked about. That's been building for a long time. I'm not the only one that's talked about the excessive margin debt. It's just a condition. It's not a buy or sell trigger. Just like overbought, divergences, those are not timing indicators. They're just conditions in the market. When they all come together, they can not only help identify a trend change, but also the magnitude, how big that next trend change, meaning that next bull run or bear drop will be. All right, so now things that I'm bullish on. We're going to go through those in this order today. I'll kind of do it a little different today. Gold, I've been bullish on this for a little while here lately. Still longer term bullish, very much so. Talked on that quite a bit. Bullish falling wedge, positive divergence, everything you want to see. Pull back to support, breakout, hit my first resistance level, first price target, and just today hit the second price target. And we did so with some negative divergence. So at this point, not a bad place to book some quick profits. But I can also make and have the case that that this pullback, especially looking at the daily charts, which I've done recently, may be or I believe is quite likely a correction within a bull market, and this could be the start of the next uptrend. But if you're trying to micromanage a position, maybe we pull back again, maybe not. I just want to point out these are potential divergences. They're not confirmed, but they would be if we reverse soon. If we get a bearish crossover in the PPO and it starts rolling over and we put in this lower peak that we currently have, then that would be divergence, and we had just a slight momentum fueled overshoot. So I just want to say that T2 has now been hit, and everyone has a different trading plan. Active traders can take profit there, recycle back in, or wait for a breakout and go long T3. And less active traders, swing traders, might just want to raise stops at this point. And where to? This has been the bottom of that R1 level. It's been good support. It was resistance here, so it's really now S1. Resistance 1, resistance becomes support. And so that's one area, especially if you took the long after the breakout or off the divergent low or anywhere there. That would be one objective level for a stop. Anything much more than that, you might head lower, and you could do a very tight stop, or again, just let it run if that's your thing. That was gold. Let's talk about silver, because they go hand in hand. You'd usually get more bang for your buck trading silver. Not always, but quite often. And this is what silver looks like. Same thing. Support here. I've covered this quite a bit. Support at that, what is that, 25.76-ish level. Positive divergence. And silver's kind of been grinding around in this little range right here. Bounded by this. Needs to break above, and if so, next target 27.51-ish, and then 28.49 would make sense to have a stop not too far below. But again, if you're scaling in at this point or took a long, you could give it a little more room, because look what will happen. If we dip below, we're still going to have positive divergence on that dip down, and that could still set the stage for another rally there. Okay, so in my book, to be long and bullish gold is typically to be long or bullish the euro as well, because the euro has a positive correlation to gold, meaning it tends to go up when gold's going up and down when gold's falling, and that's because the euro moves inversely to the dollar. So there we go. Euro, we had this bullish falling wedge pattern here on the 60-minute chart I recently highlighted. We broke out, back tested. All we did at that point is put in a larger divergent low, and now we need to take out these previous reaction highs. If we do, we're going to have a decent rally in the euro, which should be net bullish for gold and silver. I'll go over the hit on the dollar. Well, let me just do that now. I was going to stick with those things I'm bullish on, those I'm bearish. But again, the dollar is going to be an inverse chart for the most part of the euro. And it's simple, really, because the euro is the largest component of the U.S. dollar index at 50. I think it's 57.6%, if I'm not mistaken, something like that. By far the largest. The next is the yen at a distant second, and then everything else really hardly even moves the needle. So that's why I chart the dollar and the euro most often. And there it is. So we had a divergent high right here. We had a bearish rising wedge. We broke down, back tested it, extended the divergent high, and extended again. We made an equal high while the indicators continue to make lower highs, and that's still negative divergence. Prices making higher or equal highs with the indicators making lower highs, and that should take us down to my targets here on the US dollar, which again should be net bullish for gold. Lumber, we're pushing the limits of where I wanted to see that pullback stop. Let me pull that chart up. We have right here, this is lumber futures LB, 30-minute chart that I've been covering lately. We continue just barely holding on to these divergences here, but still there. We have about equal lows here down. I'm trying to move that line down right there on the PPO. RSI has higher lows with prices making lower lows. That's positive divergence. Remember, we already hit the first target right here, had a pullback, and T2 remains 934. T3 remains 1190, and I want to show you the long-term chart of that. Okay, this is an end-of-day chart. It's a daily chart, similar to the one I've been showing you, but the other one had a lot more lines. It's a little more busy. The level that I wanted to highlight was this major reaction high, that bull market peak back in 2018. It's a major level. Bring that line across, and we had reactions. There was a reaction there, a couple of gaps there, and a major reaction low right there. That's what we hit. This is an end-of-day chart. EOD right here means end-of-day. They populate on this platform. Oh, I just realized I have some of it cut off for you there. You can probably see the entire chart right now. And we hit it yesterday. Now we're a bit below it today. We're down to about a little bit, fairly below, about 624. I think it's going to be an overshoot. You know, I talk about that often in trading. It's another term I made up called a momentum-fueled overshoot. When you have a lot of velocity to the downside, you tend to not hit and bounce off a support level. You tend to shoot through it and then snap back up. And the analogy I use is a pitcher, you know, cooking a 90+ mile an hour fastball. When he hits that catcher's glove, it's not going to stop right there. His glove and his wrist are going to snap back and then snap again back forward from the momentum of that ball hitting the glove. And that's kind of what you get there in trading. So now, really, if it's much more than that, there's something going on here. This has been about a 60% plus drop in lumber futures. Again, fully identified in advance. You know, as we were going up and we went parabolic, I highlighted how these parabolic trends usually end with very swift and powerful drops. It's just the nature of this beast. But again, you're looking at lumber already coming way down. There is a commodities bubble. Inflation is running red hot, hottest it's been in what, 13, almost 15 years or so. Again, we had another hot CPI number that came in this week for the previous month. And so that's the story. And so you want to, you know, I'm still a longer term bull on commodities, and I like buying pullbacks to support, especially when you're oversold. That's the thing. This is indicative of bull market action right here in lumber. We've taken out all the previous reaction highs. That's bull market stuff right there. We had persistent overbought readings. You know, in a bear market, you get persistent oversold and extreme oversold readings, but a trade of a bull market is persistent overbought readings. And again, it's a hell of a correction, but it's the nature of the beast for lumber. So watching this one closely, expecting a reversal soon. What would stop that? I mean, anything is possible, to see the markets crater, but I don't think the market's going to do anything very big until at least after the FANGs report in the next couple weeks here. So I think we'll see lumber prices stabilize here real soon. Again, it's pushing the lower limits of where I thought this pullback might go right here, and I'll continue to update this. Moving on to some of the things that I'm bullish on. There's two more. The grains, I've highlighted those recently. We've had a few trades in the last couple of weeks. This is ZW wheat. Just nice, I marked this chart up a little bit. You can see it's wash, rinse, repeat stuff. You look for these divergent highs, and then you look for sell signals, you get a correction. You look for divergent lows, all the better. If you can have a buy signal, such as a breakout of a bullish falling wedge like you did there, you get a trade. And then you see these divergent highs come in. It says, hey, we might get a trend change here. We have negative divergence, and you did. Then you had a divergent low, was pointed out here recently. We had a nice clean downtrend line. Pop, we hit T1, stopped halfway to T2. So this is what I did today. I gave you these charts this morning. I've added two more levels that I noticed on the chart, and that one we have reactions there, reactions in here, here, and that's also so far today where we stopped. So that's resistance. This is still, it was my first target before. It'll still be, well, no, we went through it. So I'm favoring a move now. Let me just resequence these targets from where we're at here today, because I know these trades are fluid, they're dynamic. If you took this one, you may be in it. I talked about the divergences there and said you could give it room, or you could have stopped out when it broke below there. And so everybody's different. So, let's for now talk about what might happen from today, not what happened before. I just want to point out, that wheat trades well to the technicals, and at this point in time, yeah, that's still going to be resistance, and you could target it, but I'm favoring a move up to at least 694.76. That's this previous reaction high, and you can see here quite a bit of reactions along that level right there, some reactions there, and then this is still the next target after that, 717.67. You might want to, I like to set my sell limit orders slightly below the actual resistance level where I expect a reaction, because if the buyers step in or the sellers step in early, you could reverse, or you just trail it up. Remember, we're in a bull market in commodities, I still maintain, and there's going to be pullbacks along the way. So this may have been one of the better buying opportunities on wheat. I've talked about that quite a bit here on the ETN, WEAT. Along with corn, just a beautiful uptrend line. I mean, it just honestly doesn't get any more objective than that. When you're in a bull trend, there's no guarantees in anything in trading, but when you get a pullback to support, trendline support, that's where you want to go long. And that's what we had in wheat the other day, and that was mentioned. And so there's your entry, and this could prove to be the start of the next leg up in this bull trend that we're in right now in wheat. I'm now cover corn. They move together. And the same thing, it's not mere random coincidence that wheat pulled back to a well-defined trend line the same time corn did, but corn also had that 1917 price support there, and you can see it made a couple little jogs down there. So you could draw like this, maybe a little triangle pattern. Boom, if we can break that, we should be off to the races. Either way, you went long there, or you go long here today. I'd prefer to grab on that support, but here we're getting a little bit in no man's land between support and resistance, but you could still go long with a stop somewhat below there. And if that trend line breaks, then I'll be talking about wheat if and when it gets down to, or corn, I'm sorry, if it gets down to 1744 is another long entry. Let's clean this chart up. This is corn futures, CC. As mentioned this morning, we hit that first target I had laid out before, 566.33, and we're moving through there. Next stop 580. There's also a gap right here that may come into play, and then the high. So the bigger thing on corn is that recent trading range right here. So that's what we want to see, a pop above, very bullish. A break below obviously can't be spun as anything but bearish. But as of now, I'm near-term bullish on the grains. That's corn and wheat. Okay, now onto the dark side, stuff that I'm bearish on, and that would be crude. Crude, I'm looking for actually a major top, just like I was a couple of weeks or a couple months back in lumber. I'm looking for a major correction coming up in crude, not based on this 60-minute chart. This looks like, if I look at this, just another run-of-the-mill. You trade these pullbacks, you're going to look for divergent highs, and you get the pullbacks. Most recent divergent high, but this was a big divergent high. It was extending from this point here, building, negative divergence. We had a couple minor trendline breaks. This one so far did the trick. Went down, hit my first target, reversed a hair shy of my second target, but again, that's why you set if you're shorting, you cover a little bit above the actual support level. You expect a reaction, so you may have gotten out of that one. But here's what happened since. We put in a divergent high right here recently. So since my last update, we put in a divergent high, we bounced back to that $75 resistance and got rejected pretty impulsively right back down to the old former first target, 72.49. So we need to break that. I think we will. That'll take us to T2. We already hit T2 once, or came close enough, so we may bounce. If we do, then you want to look for a bounce back to 72.50 to short. But I wouldn't be surprised because we came close enough, so effectively that's a hit of that level that we go on down through and to my next target, T3 at 66.61. Okay, and this is what makes me longer term bearish on crude and more apt to tuck away at least part of a short position here to see if I can get what I call a runner trade instead of a quick pullback swing trade, get 5, 10, 12%, move on to the next one. Might be looking at one of these right here. These are all well in the double digits. This is log scaling, so don't underestimate a drop from right here, which was about $80 a barrel in crude, down to about that. It's about 50. That's a huge drop. This is a massive drop, 150 down to 35. Again, log scaling puts things in, it's just a much better scaling method to use than linear or arithmetic scaling. So I use log scaling, and these moves are big. These are major tops. What do I see on this chart? To just kind of sum it up real quick, starting with what we have right now. We have both overbought conditions and negative divergence. Number one. I'm going to circle all the divergent highs right here. You can see what happened if you shorted there, and let's say you held for the entire reward. You were down there. We had divergence right here, a little correction came after that. We had a divergent high right there, one of the biggest drops in history of crude. Divergent high there. You get the point. And I also look for these divergent lows, which are bullish. All right. So that's one thing, divergent and overbought conditions. So I also have circles where we're overbought. There's an overbought condition. Here's overbought condition right there. Again, you just follow prices to the right, see what happened after we're overbought. And I like much better overbought with divergence because quite often that initial overbought reading results in a correction, a little correction, but the uptrend continues. Then you put in the lower overbought condition, i.e. negative divergence, and all the better as well when you can get divergence on both the RSI and the PPO. You don't always get that. Sometimes it's just the RSI, and sometimes it's the RSI and the PPO. Okay, so that's what I see in the chart now. Not just divergence, because I always say divergences are not a sell signal. We don't have, other than on that 60-minute chart, on this daily chart, we don't have a sell signal in crude yet, but what I do have is crude running into what I believe is a major resistance level right about where we are right now, 75 and change, call it. Why is that big? Well, it was a major reaction high back here in 2006. We hit it again, pulled back, then we broke out, and that was a major breakout. We didn't just meander around. We broke out and ripped up to all-time highs, record highs in crude oil, about 150 a barrel there, close to it. I think it was 146, if I recall right, somewhere in there. Then plummeted. Oil crashed. Got too overbought, way out of line. Then you can see we traded around that level. There was a chop through it a little bit there, but there were still enough reactions. Pulled back, support, right? So this established that as a very key level back here in the 2010 to 2013-14. And then what happened right here? We broke it. And when we broke it, we didn't meander on through there. The bottom fell out of crude oil. Okay, so that shows that was a very significant technical level. And if that showed it back then, it was even more so back here when we rallied up, hit that level to the button, couldn't get through it, and then boom, one of the biggest drops again in years. Crude drop cut in half from about 80 down to almost 40, almost got cut in half on that drop right there. And now here we are again. So whereas I don't have a sell signal on this daily chart, I would if we break this trend line right here, this uptrend line. I do have crude rallying into resistance. So I tend to short one of two instances. I either short a break of support, which could be uptrend line or horizontal price support level, bearish chart pattern, or I short a rally into resistance if I think that resistance level will cap the advance. And that's what we have on crude. So there's a case for a longer term short. And just like lumber, look at lumber prices. They went crazy, insanely high, but they came back to earth because it was a crowded one-sided trade. And crude tends to do that as well. So there it is. And like anything else, I just laid out some pretty strong convictions that I have. But you don't get married to it. If you're going to go for the big trade here and you're looking for that 20, 30, 40+% drop, you can allow yourself a pretty wide stop. If you're an active swing trader, we'll focus on that. Go back to that 60-minute chart, and then pick your stops or set your stops depending on what target or targets you're going for. Next target will probably be down here somewhere. I'll have to study the chart a little further if we start to approach T3 and I don't see enough in the charts to get me to cover. I do think we'll get a reaction there most likely as of now, but we'll be maybe talking a different story if this next week we're heading there and something else comes up. Okay, and I'm still bearish on the financials. I think that's a sector, and I have thought for a while you can be short for a swing or a trend trade. We had a sell signal back here, went and hit my first target. Let me zoom in a little tighter. And as I mentioned yesterday, this is the big earnings week for the financials. So we bounced off T1, which is to be expected. Usually you get a reaction on the initial tag with target. We even checked it again, but so far we're stalling out here, and that's near-term resistance right there. So the financials are down yet again today. I told you yesterday we had, we had JP Morgan reporting yesterday. Today, Bank of America, Wells Fargo, and we have some others coming up. Now let's just take a look at that. JP Morgan is the largest financial. They reported, and they've done nothing but sell off since. Nothing big. I have to give it that. We still need to take out the reaction low. But let me just flip over to something here. All right. Here's the headlines from the Journal, Wall Street Journal news report. JP Morgan profit more than doubles. So they doubled their profit. Revenue fell, but so far, so they double on a profit, and they're still selling off after earnings. What else did we have? We had Goldman Sachs profit revenue jump. Profit jumped to 5.49 billion in the second quarter. I mean, this company made $5.5 billion in profit, not revenue, profit in the second quarter. That's huge, and it's a rosy headline. But let's take a look at Goldman. What's Goldman done since then? It's one of the top components of the financial sector, and nothing. It's selling off on that. So look, not big. The bottom line is the financials like XLF and these banks have to take out these recent lows, and I think they will. And I give you additional targets on all these. At minimum, I think Goldman's coming down here to that level. It's about 320 or so. And maybe more, we'll see. And if it gets there, that's going to be a decent drop since we had the sell signal a few weeks ago, about 17%. I think that's what I was calling for before. All right, and we have the others coming up, I think, tomorrow. So quite a few. Let's see, Citibank, Morgan Stanley, and maybe one or two more. Okay, and I mentioned recently I'm bearish on the retail sector. It needs to take out these levels. We're right there, close to it. I see this as one of my favorite sectors for a swing short. XRT is the ETF if you want to short the individual ETF. I think there's a lot of meat on the bone there. A little work to be done. We need to, we get all these retail stocks reporting. That'll probably be the catalyst. And then I told you can buy this ETF if you don't want to short or you can't short. EMTY, it's called the ProShares Decline of the Retail Store ETF. So, death to retail a la Amazon. And so that's what they're holding a basket of, shorting a basket of a lot of brick and mortar retailers there. And still hasn't taken off yet, but I think it will. So, and it doesn't have leverage, so you can get in a little early and hold this one. You're not going to have the decay like you do with a lot of these 2 and 3 time leveraged ETFs. Okay, and then last but not least, the industrials. I'm still thinking, there's more downside to come. There was our sell signal trendline break on XLI right there, and we hit that, undercut that first target of 101.37 by a day, and we've been dancing on it since. Remember, that was our sell signal there, our breakdown of the primary trend line, first target hit, and we've been bouncing on it for a while now. So that helps to validate this as an important support level to me. And if and when that goes with conviction, it opens the door to my next targets: 98, 97.80, 93.80, 90.25. Okay, that's it. So there is the some of my top picks and the stocks I'm watching lately. There's not just stocks, individual commodities as well, gold, silver, things like that. And I'll continue for the time being to keep this focus. If anything else stands out, I'll integrate that into the videos going forward. But lately I've just, keeping trading light. Individual stocks are tricky during earnings season. You have to know which companies are reporting, and even if your individual company, let's say you're long or short a retail stock, or a bank or any, and then you say, okay, I'm okay here because that one doesn't report for 2 weeks. I check the earnings. I have an earnings calendar on the site you can reference under the resources tab. So let's say you checked it, your position, you don't report for another 2 weeks, but guess what? The leader in that sector, let's say another big bank or retailer reports tomorrow, that can set the trend for the entire sector. And so that's why I'm saying trading during individual stocks during earnings season is pretty tricky. It's tough to navigate, and you might be better off on ETFs or keeping things light. It's also one reason I like commodities. You don't have any earnings. There are sometimes some reports that come out that will affect commodities, no doubt about that. But hey, it's all part of trading a diversified portfolio. A little bit of precious metals, sometimes crypto, sometimes commodities, sometimes, or most of the time, all of the above. All right, we're going to wrap it up here. Long video, but hopefully you guys found that useful. This has been Randy Finney with Right Side of the Chart. Have a great day.